Well, welcome to Leases Bite Size. So, I'm aiming to go through some key points on leases for the SBR exam, and we're going to be looking at what is a lease, lessee accounting, lessor accounting, which is new for SBR as opposed to financial reporting, sale and leasebacks, and then you get a little Q&A. Pop some questions in the chat if you want to, and I can stop, or come off mute and ask a question. That's absolutely fine. This is all about you and your understanding. So please make sure that you stop me if you're not understanding. Brilliant. So, what is a lease is the first thing. So IFRS 16 defines a lease as a contract or part of a contract that conveys the right to use an asset. So it has to be an identified asset for a period of time. A period of time can be anything greater than 12 months, or well, in fact, less than 12 months if you want it to be, or it can be anything up to like 10 years or something like that. So it's got to be a period of time which is continuous, shall we say, for consideration. So the user actually needs to have the right to obtain substantially all the economic benefits from that identified asset. So it has to have the benefits. It can't just have part of those benefits. It has to have the whole benefits. And it also has to be able to have the right to directly use of the asset for the period of use, so the time of the lease, be that anything from less than 12 months up to however many years. It's endless. So really focusing on those 2 points, all the benefits and directing the use. So what about this one? Is this a lease or a delivery service? So Clarence enters into a contract with Hawlett Co. for transportation of goods from London to Edinburgh on a specified truck. So it specified the truck. The truck is explicitly specified in the contract, and Hawlett does not have any substitution rights. The goods will be occupy substantially all of the capacity of the truck, and the contract specifies the goods to be transported on the truck and the dates of pickup and delivery. Hawlett occupies and maintains the truck and is responsible for the safe delivery of the goods. Clarence is prohibited from hiring another haulier or from operating the truck itself. So what do you think? Is this a lease or a delivery service? Pop it in the chat. A, lease, or B, a delivery service? Anybody else? Anybody else? Pop it in the chat. Some people have done it privately. Let's have a look. Okay, brilliant. Everybody has it right. This is a delivery service. So this is a delivery service. Because Clarence does not have the right to control the use of the truck, because he does not have the right to direct its use. So it's not a lease. It has the same rights regarding the use of the truck as if it was one of many customers transporting goods using the truck. They are delivery slots and they're not used for a period of continuous time. So the scenario makes you think that, it's an identified asset. They have no right of substitution. There's set dates, a specific truck, it's all about, but actually this truck is not being used solely for the purpose of Clarence. Other people can put stuff in the truck and it's only on specific dates. It's just like a coach service that delivers school children. It's only used during the school children time, and the coach can be used at different time. So that would be a delivery service too, not a lease. So as opposed to this one, which is a lease with the question mark. And let's have a look at it. Under a contract between Oxford City Council and Trucks Limited, Trucks provides Oxford City Council with 20 trucks to be used for refuse collection for a 6-year period. So there's a continuous thing. 20 trucks are identified. Trucks is the owner of the vehicles, not Oxford City Council, but they are specified in the contract, identified. OCC determines how they are used in the refuse collection process. So they're using them for refuse collection. When the trucks are not in use, they're kept at Oxford City Council's premises, and the trucks can be used for another purpose if they so choose. If they need servicing or repairing, trucks is required to substitute a vehicle, but that's only if it's serviced or repaired. Otherwise, other than on default, trucks cannot retrieve the vehicles during the 6-year period. So it's very obvious here that this is a lease. There's a continuous service for 6 years. There's an identified asset of the 20 trucks. And it can only be substituted if they needed service. They directly use, they control the trucks. And therefore, during the use, they're also getting substantially all the benefits. Is everybody happy with that? Maybe I have some thumbs ups, and I can see some thumbs ups. Can you do emojis on here? Thought we could. Oh yeah, we got some emojis. Brilliant. Got some thumbs up. Well done, everybody. Thank you. Okay. Let's go on to the next one. So everybody happy? What is a lease and what is not? Now, this is lessee accounting. Right. A lease doesn't tend to have many payments at the start. And if there's a payment at the start, that is a cash transaction and it gets added to the right of use asset. But the initial inception of the lease is at the present value of the future lease payments. So PVFLP is present value of future lease payments. And so the initial entry is economic substance over legal form. We go debit right of use asset to put an asset into the statement of financial position, and we credit a loan lease liability. So we're registering the fact that we're using an asset for the period of use, and we've got a loan to pay while we use it. And therefore, it's a debit and a credit, and it's not a cash transaction. Okay? If there are any deposits in advance, they always get added to the right of use asset. So it's credit cash, debit right of use asset. They don't form part of the future lease payments. They're just an advance lease payment now. Okay? It's only future lease payments that we put on the lease liability. And those will be things like fixed and variable payments, any guaranteed residual values, any options to buy, or extension payments if reasonably certain they happen. So everything that goes into the lease liability goes onto the right of use asset, debit, credit. The right of use asset only gets added then with any extra costs that would be cash transactions. So direct costs of getting the lease, removal costs, and also any deposits or advance lease payments. Those removal costs are not cash, though. They would be a provision because they're a future. But that is not a future lease payment. It's a future removal cost, like a decommissioning provision. Hopefully everybody's clear. Subsequently, the right of use asset is then depreciated, and the lease liability is basically measured at amortized cost. We add the effective interest rate and we take off the cash lease payment. So that is everything you should have brought forward from financial reporting. That is not new to strategic business reporting. So now, also, I'm going to introduce short life and low value assets. There is an exemption that you can do if you have a short-term lease, which is less than 12 months, or it's not or there's a low value asset at new. So a photocopier, a computer, something like that. Short-term lease has to be 12 months or less. So if you have a car on a short-term lease, that is still a short life asset and goes through this exemption. But if you have a car which is greater than 12-month lease, like 2 years or 3 years, it has to be low value when new. So that would not pass the exemption. So it has to be short term if it's a car. So what can happen therefore, we can just choose to recognise the lease payments in the profit and loss on a straight line basis. And under IFRS 18, that goes to the operating section of the P&L. There's no lease liability or right of use asset recognised. So you just have to do a simple matching. So you have to match the expense to the period. And if there's a cash transaction which is different to that, you create a prepayment or an accrual. Is everybody clear on that one? Thumbs ups, please. No questions? So let's have a look if we have to remeasure a lease. This is an exam question. So using Exhibit 2, which is what we would be doing in our exam, and in accordance with IFRS 16, it says explain how to account for the lease agreement in the financial statements for the year ended 31st December XT7. So on the 1st of January XT7, meant a lessee entered into a 2-year lease for its head office. So it's lessee accounting. The annual lease payments were agreed at $500,000, payable at the end of each year. The implicit interest rate in the lease was not easily determined, but its incremental borrowing rate was used at 5%. So we're going to apply an interest rate of 5%. On the 1st of January, at the start of the lease, the inception of the lease, the present value of the lease payments still to be made was correctly calculated as $930,000. There's no deposits, nothing, okay? So we need to explain the calculation up to the 31st of December XT7. So we would explain that we put a right of use asset in at 930, and we put in a lease liability of 930. We then subsequently calculate that to the end of 31st of December XT7. But on the 31st of December XT7, the lease payment was made. Both parties agreed to extend the lease term by an additional year. So we've moved from 2 years to 3 years. We now have to present value the future lease payments and make an adjustment to the right of use asset and the lease liability. So we remeasure the present value of the future lease payments at that point, because we're no longer 1 year out, we're now 2 years out. And therefore we put an adjustment through the right of use asset and the lease liability. This is an exam question for 8 marks. So the calculations will only get some of the marks. The explanation is really important in the SBR exam. Let's have a look at how that happens. So 4 marks are going to discussing the easy bit, what happens before the remeasurement. You could pass this question not dealing with the remeasurement. So there's 5 lovely points there. 1 is a calculation, but 4 other points to write about. So you recognise the lease liability and the right of use asset at the present value of the future lease payments, 930. We then depreciate the right of use asset over the lease term, putting it in the operating section. The lease liability is measured as follows, adding interest and taking off the payment. So the closing amount is therefore shown. We also can say that interest is 46,500 and that will be charged in the financing section. And the cash repayment at the end of the year reduces the carrying amount to become that final figure, remember that figure of 476,500. Are there any questions so far? Okay.
If the interest liability charge is going to the balance sheet, is it a short-term liability or
Sorry, not the interest. The interest liability, the interest goes to the P&L. You mean the closing liability?
Yeah, sorry, closing.
Yeah. So you'd need to work out what is due in less than 1 year, and therefore, at the moment, that would be current liability because it's closing within 1 year. Yeah, all of it.
Okay.
Well done. Well
Thank
done.
you.
Yeah. So then we get to the remeasurement. Well, the remeasurement is now you need to present value those future lease payments. We're going out 1 more year. So we've got 2 more years left, and we're going to pay 500,000 over XT8 and XT9. Remember, we are remeasuring 1 year in. And so the value they gave us a new interest rate to use, which was 6%. So 500,000 present valued over 1 year for XT8 is 471k, and from 2 years out would be discounted back for 2 years, and that would be 444k, adding up to 917k. So as I said before, we write out what we're doing, and then we adjust the right of use asset with the difference between the lease liability before and the lease liability now, and we obviously increase the lease liability to 916. That's all you need to do for the 4 marks. And again, there's more than 4 marks going there. There's 5 marks going for that part. So even if you didn't write the explanation perfectly, you would probably still max out on marks. So this exam is all about making sure you get the 8 points down, including a calculation within that, for the 8 marks. My answer has 10 marks, being the 5 points there and the 5 points there. And you would be maxed out at 8. So this is a test of making sure you don't overwrite, but also making sure you write enough. And I would be happy if any student managed to get 6 out of 8. That would be a really good answer for you. Do I have any other questions? Is everybody understanding that? Excellent. Right, now we're going to move on to separating multiple components of a lease. So sometimes the lease has a lease in it and a service component, which is a non-lease component. So the entity must split the rental or the lease payment and account for the lease component under IFRS 16 and account for the service elements separately, generally as an expense in the operating section of the P&L. So if you're required to do this, the consideration in the contract is then allocated on the basis of standalone prices of the lease components and the non-lease components. So this is my example. Livery company leases a delivery van from Bitesize for 3 years at 12,000 per year, but this includes servicing. So therefore there's a lease and a non-lease component. We need to split it out. They've given us some standalone payments there. So the 12,000 needs to be split by doing the lease, which is the 11 standalone, over the 11 plus the 2. So therefore that would give us 10,154. And therefore the remainder between 10,154 and 12,000 goes to the servicing component in the profit and loss. So it's just basically taking a proportion based on the standalone selling prices. And as the standalone selling prices add up to 13, then it would be 11 over 13 times 12, and it would be 2 over 13 times 12 for the servicing component. Hopefully that is clear. I think this recently came up this year, this sitting, in an exam question. So the last sitting was September, and I got a feeling this came up. So it's a good thing to have done in case you see it in your exam. So that's lessee accounting. It gets tested. It either gets tested as remeasuring a lease, or it could get tested by separating out a lease component and a service component. You're moving, you're moving away from financial reporting into strategic business reporting. They are going to complicate things. Now, the new area for you is lessors. Now, with lessors, we do have a lease classification issue. There's two types of leases. There's a finance lease or an operating lease. And you need to focus on the finance leases where the risks and rewards of the underlying asset is transferred to the lessee. From a lessee point of view, it's either a lease or it's not. And the only exemption is if it's short life or short value. Hopefully everybody's clear. So with lessor accounting, it is again substance over legal form. If we've transferred all the risks and rewards, which means it's a finance lease, therefore we then have to de-recognise the asset because effectively we do not own the asset anymore. And instead we own an investment in the lessee, sorry, I'm getting confused. And therefore we have an investment in the lessee. Okay. So the investment in the lessee is that good old present value of the future lease payments, plus any guaranteed or unguaranteed residual values. We de-recognise the asset because effectively we don't own it. And what we have in the P&L is finance income from that investment and a profit and loss on disposal of the asset. It's very easy if it's an operating lease. We basically keep the asset in the books, depreciate it, and recognise the lease payments as rental income. Sorry,
I just had a quick question. What do you mean by guaranteed and unguaranteed residual values? Like, will they tell us if it's a guaranteed or an unguaranteed value?
Yes.
Okay.
So we're going to look at an example, and that will come. Brilliant question. And
good.
Basically, in the lease, it will say the guaranteed residual value is X, but potentially they could sell it for this. And therefore, if they take the asset back and they sell it for this, that would be the unguaranteed value. Okay, I'll show you this in an example.
Cool. Thank you.
So here we have able leasing. It's leasing an item of equipment to a customer commencing on the 1st of January. The expected economic life of the asset is 8 years. So we need to look at the indicators of whether it's a finance lease or an operating lease. The terms of the lease is 8 annual payments. So if the economic life of the asset is 8 years and the lease payment years is 8, we're going to be using the asset for the whole of the lease term, and therefore the asset should not have much value at the end. That would indicate it's a finance lease. All the risks and rewards of the assets have been transferred away from the lessor. Then we get to this point where we have the lessee guarantees the residual value of the assets of 2 million, which is your question, but it expects to be able to sell it for 3 million. So the unguaranteed residual value is therefore 1 million. Guaranteed is 2, unguaranteed is 1. Does that answer your question?
Yeah. So in another question, we'll just subtract them.
Yeah.
Okay.
Yeah. So it may give it you differently, but when they say it's able to sell it for 3 million, the guaranteed is 2. If they're able to sell it for 3 million, then the unguaranteed is 1.
Okay, fine.
Yeah.
Okay, that makes sense. Thank you.
And then it tells us what the present value of the lease payments, including the residual guarantee, just the residual guarantee, which is the 2 million, is 25.9. It then says it's equivalent to the purchase price. Well, that's the second indicator of a finance lease, where the present value of the future lease payments effectively equals the fair value of the asset. The fair value of the asset is effectively the capital value of a loan. You're taking out a loan to buy an asset in full, because if you discount the fair value of the future lease payments, that would end up being the capital value of the loan. Hence the reason that means it's a finance lease. Note the implicit rate interest in the lease is 6.2%. for when we do the answer. So let's have a look at the answer. So the arrangement is a finance lease. And for the two reasons I said, the economic life and the present value of the lease payments is substantially all of the fair value of the asset. Therefore, it recognises a lease receivable, an investment. So we need to do the present value of the lease payments, which was the 25.9, and now we need to do the present value of the unguaranteed residual value, which is the extra thing that you need to do in lessor accounting. And of course, that's after 8 years, that 1 million. So we discount it back by 8 years at 6.2%. 26.5, therefore, is our investment. We therefore need to de-recognise our asset, which is in our books at fair value, and we therefore debit the investment 26.5, credit the asset out the books, and credit a profit and loss on disposal of our asset. It's a made-up thing, remember. We haven't actually disposed of the asset, but for accounting, economic substance over legal form, we are. We then move on that lease receivable by 1 year by adding interest income and taking off the lease payment. That interest income will go in the investing section of the profit and loss because it's an investment. Okay, don't put that in financing. It's an investment, so it needs to go in the investing section. So hopefully that is clear. Okay. I'm basically reminding you of your tutorial that you would have done already last week in week 1. This is just giving you a little bit more of a flavour and getting you to think about the questions and relating it. Then we come on to subleases. So this is definitely SBR. I've heard that this is in a question in the exam. We haven't seen the question yet, but we do need to make sure we cover this in case it comes up in your exam. So imagine you have a building. You own a building, and that would be entity A. They lease the whole building to entity B. So the head lease is the building owner, the head lessor. Entity B is the head lease lessee. They're renting the whole building of entity A. It's a lease, okay? Lessee accounting. But then they sublet it. They don't want all of those floors in that building, so they sublet it. And therefore, that becomes a sublease. They are now a lessor. Entity B is a lessee and a lessor. How do we account for that? So we need to understand, think about it. A building contractor owns the building. They lease it to a tuition provider called Joe Tuffle. But Joe Tuffle doesn't need all of those floors. So she leases it out to people doing, I don't know, human resources or accountancy practice or something like that. They become a sublease. So hopefully you can imagine that. So remember, the lessee accounting holds whatever we determine the lessor is doing. Whatever we determine the lessor is doing, the lessee accounting always holds. So if the sublease is a finance lease, then we've transferred the risks and rewards. Then we have to de-recognise the right of use asset, re-recognise an investment, and create a profit and loss on disposal. But we always retain that lease liability because that's lessee accounting. Okay, that's lessee accounting. If it's an operating lease, we haven't transferred the risks and reward. So we retain everything to do with that lessee accounting, the right of use asset and the lease liability. And all we then recognise is lease income from the sublease. Which one is harder, the finance lease or the operating lease? Can I have somebody telling me what they think? Which one's going to be harder? And which one do you reckon they'll test you on?
Finance.
Yeah, finance lease. So if it's an operating lease, everything remains the same and all you do is recognise lease income for those lease payments. But the finance lease is the harder thing. we have to de-recognise the right of use asset, recognise an investment, recognise the difference in the P&L, and then retain the lease liability. So let's have a look at the example. So on the 1st of January, Amelia Limited entered into a 4-year lease for a machine with monthly rentals paid in arrears to Lucas. The present value of the minimum lease payments were 2 million, with no initial payments were made to the lease. So therefore, the lease liability is 2 million and the right of use asset is always 2 million too. There's no initial payments to add to that. So therefore, we then depreciate it over 4 years. But now, on the 1st of January, Amelia subleases the machine. So we have to de-recognise the investment in the lease and recognise an investment in the lease. So the present value of the sublease minimum lease payments of 1.2 million, and Amelia has correctly classified the sublease as a finance lease. The carrying amount of the head lease liability is 1.1 million. So the right of use asset is therefore de-recognised because it's a finance lease. And investment in lease is recognised at 1.2 million, which is the minimum lease payments. And therefore, the head lease liability always remains as this is the lessee accounting. Everybody happy with that? So let's have a look. Anybody need any clarification? So the sublease is a finance lease, meaning the risks and rewards of the right of use asset. Amelia must de-recognise the right of use asset. Now the right of use asset has moved on 2 years. So 2 million depreciated over 4 years means it's halved in value and it's now 1 million. Remember that 2 million was the present value of the future lease payments at the inception of the lease. So we went debit right of use asset 2 million, credit lease liability. We then record the net investment receivable in the sublease being the present value of minimum lease payments of 1.2, and we record a gain and loss on disposal of 1.2 minus 1, 0.2. We just retain the lease liability then on the head lease. So 1, 2 and 3 is effectively lessor accounting, and number 4 is the head lease accounting, retaining that lease liability. It all seems pretty easy, doesn't it, when I do it? But remembering this is not going to be easy. So these are the things that you need to make sure that you're happy with going into revision. Okay. So that is lessor accounting. The final thing I want to go through is sale and leaseback. Sale and leaseback. So with a sale and leaseback, we're now going forward and we're only going to be going through questions to do with it is actually a sale. If it's not actually a sale, then then it's seen as economic substance over form. If they haven't actually sold the asset, they've retained some rights to the asset, then effectively that asset is security for a loan. And therefore all you do is you effectively put a loan in the accounts and you retain the asset. But often in questions, it tells you it is a sale. And therefore, this is then a sale and leaseback. So what happens if they've sold an asset? Let's imagine this asset has a useful life of 20 years. And therefore, if you've sold your asset, you dispose of your asset and you make a profit on disposal. However, only on the rights transferred. If you then lease it back, so this is common practice, a building, a machine, a lorry, whatever. If you then lease it back, and it's really about the fact that you're trying to release financing for yourself. If you've retained some of the rights, you haven't retained all of the rights, then we need to recognise a lease on those rights retained. So as you can see, this useful life of this asset was 20 years, but we've only retained the lease, which is only 5 years. Now, we don't actually base it on the number of years, by the way. We base it on the present value of the future lease payments as a effectively as a percentage of the fair value of the asset. So the capital value of the asset, and what is the capital value of the loan? Think of it like that. But I like to give you an analogy by saying, look, we've got rid of this asset, which is 20 years useful economic life, and we're leasing it back for 5 years. So we're allowed to recognise a profit on what we've transferred, which is basically 15 years. But we have to recognise a lease and a right of use asset on what we've retained, which is effectively 5 years. Everybody clear on that? Any questions before I move into it? Okay, so now we have sale and leaseback. The seller, the lessee, must measure the right of use asset as the proportion of the previous carrying amount that relates to the rights retained. So therefore that would be the 5 years effectively. This means that the seller will recognise a profit and loss based on the rights transferred, which will be the 15 years effectively. And then the lessor then accounts for the purchase, and the lease is accounted for applying lessor accounting requirements. Is it a finance lease from a lessor's point of view, or is it an operating lease? Often you would see it as being an operating lease, more likely than not. But there is an issue. Sometimes the transactions may not be at fair value. And if the sale proceeds or the lease payments are not at fair value, then unfortunately, if they're below market terms, then that means we should be treating it as a prepayment of lease payments. And all we need to do is we literally add that to the right of use asset. So if the fair value, the sales proceeds are less than the fair value by say $500,000, then all we do is we add a debit to the right of use asset. Debit to the right of use asset. Okay. If it's above market terms, then it's treated as additional financing. This is where the sales proceeds exceed the fair value of the asset. And all we do is we create an extra loan. So the $500,000 would be a separate financial liability. We would add a credit. So the first one, below market terms, we create an asset, we add it to the right of use asset. If it's below market terms, we create a separate financial liability. So let's have a look at a question. On the 1st of January, Mosaic sells an item of machinery to Ceramic for $3 million. Its fair value was 2.8. So the proceeds exceed the fair value by 0.2 million. That means there's a further liability. The asset had a carrying amount of 1.2 million prior to the sale. So currently, if we were to account for this as just a sale, we would be debiting cash 3 million, crediting PPE 1.2, and crediting the profit and loss with 1.8. But we have sold it and we are just about to lease it back. So as the sale represents a sale, i.e. a satisfaction of a sale according to revenue with contracts with customers, Mosaic then, unfortunately, means he's now entering into a contract to the right of use asset over the next 5 years. That means he's now got a lease. We cannot recognise that 1.8 million, therefore, as a profit because we haven't transferred all our rights. We've only transferred some of our rights. We've got some rights retained, and that is a lease for 5 years. As the annual payments of 500,000 are due at the end of each year, interest rate implicit in the lease is 10%. We have calculated the present value of the annual lease payments to be 1.9. Okay. But the rights retained are 1.9. Fortunately, that lease liability also has an issue of extra financing because of that 0.2. So now we have to reduce that lease liability to be 1.7 and create an additional loan of 0.2. So now going forward, we have a lease liability of 1.7 and a loan of 0.2. The right of use asset is the calculation you need to learn. It's going to be the present value of the minimum lease payments, which is the rights retained, over the fair value of the asset, which is the total rights of the asset, and then we times it by the carrying value of the 1.2. Let's see how that works and when I show you the answer. So first of all, Mosaic must remove the carrying amount of the machine from its statement of financial position. And that would be credit property, plant and equipment and debit cash. And then normally we would create a profit and loss on disposal. But we can't do that yet. We have to find an adjustment to that profit and loss on disposal. And we do that by recognizing a right of use asset. And this is measured as the proportion of the previous carrying amount that relates to the rights retained. And it's calculated as being 0.73 million, which is the 1.7, the lease liability, over the 2.8, the fair value of the asset, times by the carrying value. So the 0.73 is key because now that helps us with our journal. So here's our journal. The first entry is what we received in cash. Debit cash, credit machine. Okay. Got rid of the machine out of our books, the 1.2. That was our carrying value. The second double entry is to put the right of use asset in and the lease liability and the financial liability. If the fair value of the asset had been the same as the cash received, then we would literally have done credit lease liability 1.9. But because it wasn't, we had to do that extra finance liability. And as you can see, once you put those entries in, the balancing figure is your profit and loss on disposal. And that is the profit and loss on disposal of the rights transferred. Notice it's no longer 1.8 million. It is 0.63 because we didn't transfer all our rights. Hopefully that's clear. That will take a bit of time to go through, but it's really important. It's quite a key area that the examining team like to test. Leases, absolutely. And unfortunately, there's three things that they look at. Lessee accounting with those couple of complications. Lessor accounting, is it an operating or a finance lease? Subleases, and also sale and leasebacks. Lots to cover, lots to test, and lots to understand. Let's have a look at, though, from Ceramic's point of view. We've done Mosaic. From Ceramic, remember, it is a lessor. And they will post in what they paid for the machine of 2.8 and financial asset of 0.2 because the fair value of the machine is 2.8 and they paid an extra amount of 0.2. That is equal and opposite to the financial liability that Mosaic put in. Hopefully that's clear. We will then account for the lease using normal lessor accounting rules. It's a finance lease if the risk and rewards have been transferred back. Otherwise, it would be an operating lease. We don't know that here because they haven't given us enough information. But one thing you will potentially need to understand is we do also need to split the payments and receipts between Ceramic and Mosaic will be allocated between the lease and the additional finance or that financial asset, okay, in proportion to the total present value of the payments that each element represents. And so The 500,000, again, we use that pro-ratering thing. So the lease element for Mosaic will get 1.7 over 1.9 times 500,000, and the additional finance will get 0.2 over 1.9 times 500,000. Okay, hopefully that is clear. So, are there any questions after all of that? Or you're just going to review this again and maybe go over leases again before we go on to revision? Can anybody let me know? Was that clear? Was everybody happy? Was it a good thing to do? Giving you context.